Hello, everyone. This is Ed McGill, co-founder and partner of McGill Junkie Wealth Management. And again, I'm joined today by Jason Kirchhoff, our Director of Investments, for the third quarter quarterly commentary. So we're going to talk about what's going on in the world, our clients' portfolios, and just the economy in general. So Jason, thanks for joining us again. A lot of exciting things to talk about, bud.
Yeah, thanks, Ed. No doubt. There's never anything boring, for sure.
That is true. We're going to leave off the political slant and things on the TV and all those things. But in your latest quarterly commentary, you actually wrote about a board game that you play with your boys, and then how does that fit within the construction of a portfolio. I got to admit, I'd never heard of the board game before. So tell us a little bit about it and how that fits into our clients' portfolios.
Yeah, it's a good question. Maybe I should take a step back. I get asked quite often, like, what are some good investment books if younger people are trying to get into the industry? What should they read? And I give them a list, and there's a couple books on there that seem to be a contradiction. One of them is called The Wisdom of Crowds by James Surowiecki, and that was written in like 2005. And it really talks about how if you have independent, diversified thoughts and you can aggregate them, a lot of times the aggregation of all those ideas is wiser than if you just had individual experts talking about how crowds can make pretty good decisions. But there's another book that was written, I think it was like in the mid 1800s, by Charles Mackay, where he talks about the madness of crowds. And he highlights a lot of examples like the tulip bubble or the South Sea bubble, or even the idea of alchemy and how people, common narratives develop and people kind of lose that independence and diversified thought, and things go terribly wrong. And I think both those books are important and they're both right. So I kind of wanted to highlight that a little bit with this piece. And to do that, as you mentioned, I use the reference of the game Wits and Wagers. And all three of my kids will play with me sometimes, although they're all teenagers now, so it's a little difficult to make that happen. But it's a game where it's a quantitative question, such as what was Walmart's revenue in 2025? And it's these questions that are almost unknowable. Nobody knows the answer, but everybody writes down a guess in private, and then you flip them over and arrange them from low to high. And it always amazes me that no matter the question and no matter the group, if you have diversified thought, the answer is kind of the average of all of it, right? You get to that middle answer. People have ideas, and if you just kind of take the average, you oftentimes get very close to the correct answer. With one exception, if there's cheating, if somebody looks at somebody else's card, or somebody throws out some number like they know something, all of a sudden that anchors everybody else's guesses, and all the guesses get really tight to each other, and oftentimes it can be completely wrong. So I just wanted to highlight how the wisdom of crowds, for the most part, works in the markets. But we have these periods where the narrative gets so strong that people kind of lose their independent thought and just kind of go with the flow. And we see those events in the markets every once in a while.
Well, it's interesting, as you were saying that, actually separate from the markets, what my mind went to is, depending on which side of the political spectrum you lean, and you only listen to one specific channel or channels that are only going to solidify your thoughts, that's when people can become dangerous, where they think their opinions are facts, and that'd be true on both sides. So that there really isn't diversification of thought and everyone's just saying the same thing. What you just said is that can also happen in the investment world. Tell us about some specific examples that have happened recently that fall into that category.
Yeah, if I think back the last few months or even years, oftentimes you've probably heard of the headline or magazine cover curse, right? By the time something appears on the cover of The Economist, it usually means everybody agrees with that and it's about to turn. So one we've seen recently, the idea of American exceptionalism, right? That you don't need to invest anywhere but the U.S. large cap companies and you'll be fine. And we've started to see a little turn there. And I'm not saying that is over, but that's one example. And if I go a little further back, you can think of the idea that inflation was dead, right? That we would never see inflation again. And obviously COVID kind of screwed that up a little bit, but there was another magazine cover where, the idea that we wouldn't see inflation again. And the opposite of that is not quite the opposite, but the idea that inflation is just transitory. The inflation that we've seen, oh, that's a short-term thing. It'll go away. And it's been almost 5 years now that we've been above the central bank's target of 2%.
That's interesting. And so when you think about, as we build portfolios here at the firm, so, we do build our clients' portfolios, the allocations, it's all based on their plan, but there still is, what actual are we going to put into that portfolio? Give us maybe some examples of things that we've done, the course of this year. Could be we're at the end of the third quarter, another good quarter, but was there certain things in the third quarter, or is it more of maybe this kind of year trend, or is it even longer than that? But what are some of the things that our clients would like to know, have happened in the third quarter or year to date tied to your quarterly commentary?
Yeah, as I mentioned, most of the time the crowd is going to be correct. High frequency of the crowd being correct. But there are times, low frequency events, but they have large magnitude, meaning kind of on the tails of a distribution. There's a portfolio manager by the name of David Dredge who writes commentary for a firm called Convex Strategies, and he uses the analogy of a football field, right? Most of the time, the game is spent between the 10-yard lines. And not a lot happens. It just goes back and forth. But it's when you get to the edges, those low probability, low frequency events, when you're inside the 5, that's when most of the scoring happens, both positive and negative. And I think that's the same with markets, right? That most of the time, the crowd is correct. It's those periods where the madness of crowds take over that you want to be a little concerned and think about risk management from a portfolio construction standpoint. So when we think about, and I'll use that American exceptionalism, if we go back a year or so and there was some talk about, why don't you just hold the S&P 500? And we looked at the valuations of international developed, Western Europe, Australia, Japan, as well as emerging markets. And we said, those companies, obviously the narrative isn't strong, but the valuations are incredibly cheap.
Yep.
Let's maintain our exposure there. And we're seeing that. Obviously, it's a short time period, but year to date, those are doing incredibly well compared to U.S. A more narrow example would be our allocation to natural resources. So that's another area that, if we go back a year, incredibly underloved. Nobody needed real assets. Nobody needed those kind of building blocks of the economy, natural resources such as energy, precious metals, industrial metals. But we've seen those do extremely well as kind of people come around to that idea that actually we do need all those things for modern life.
And what would have caused the thinking that those weren't needed? Because when you say like energy, I'm like, well, Jason, everyone's needed energy. Was it more just the lack of investment into the infrastructure to produce that, and now realizing whether it be because of COVID and saying, hey, we need to produce these on our own, or what actually causes that? And then when did we add that specific fund into our client's portfolio? Because yes, it has done unbelievably well, but I also heard you tell someone, look, this is not something we'll hold in here permanently. Typically, this is not a core holding like the S&P, like a large cap index or something like that. Talk a little bit about that, of what we've done there.
Yeah, it's a great point, because the impetus, the rationale to add that exposure about a year ago was based on capital cycles. And what you see, and this kind of rhymes with wisdom and madness of crowds, is that if you go back to the shale revolution, all that capital was invested into finding new energy sources.
Yep.
And we did. We found a massive amounts. We found roughly 3 new Saudi Arabias in the U.S. through the shale fields. But the investments did pretty poorly, just the overinvestment. And then what we saw was kind of the inverse of that. Everybody got burned on that and said, well, I'm not going to invest in this stuff anymore. And we pretty much stopped production and exploration. So that was one of the reasons we went into that position, was just that underinvestment. And this cycle will happen again. We'll get to the point where everybody thinks it's the greatest thing and that the returns will be great forever. And we won't be able to call the top, but that's when we'll be looking for an exit.
That's interesting as you describe that, of, making the strategic tilts in the portfolio or adding some things to hopefully create some alpha, on the outskirts while still keeping that base portfolio aligned. And what a great commentary on just, international stocks this year versus U.S. In terms of that the international, both for large countries as well as emerging markets has done better than the U.S. and showing the importance of having the diversified portfolio. The two slides I'm going to just talk about real quick, Jason, is the one that's up there now, this integrated wealth management. So what Jason was talking about primarily was in that middle bucket right there, that core diversified growth portfolio that, all of our clients have. But diversification also is making sure we have dollars in each one of the other circles too. So most of our clients do have illiquid, higher risk alternative assets, and whether that's alternatives that we find and put into the portfolio, but it can also be so many of our clients are business owners themselves, or they own farmland, or they're investing in private equity with deals that they can find through their company. So in our clients' portfolios, we are going to have dollars in that far right bucket. We're going to have a significant amount of dollars in this middle bucket, that diversified growth portfolio. And then it's always important to have that, in this example, the left bucket, which is that safer, secure dollars, which can just be cash on hand. It can be treasuries. It can be things such as pensions. Those are safe, secure dollars. It can be, low cost income annuities. It can be cash value insurance that all fit into these different buckets. And by actually having dollars in each of them and tying it to the plan, it can make your plan stronger. And then one thing, Jason, because I wrote it down, which was good, as he said that, is it's also important to know where are those assets owned. And so in this last slide, before we let Jason close us down, is it talks about bronze, silver, gold, and it's really talking about the taxation of different types of account, because our clients really dislike taxes, on that side. So if we can have our growth assets or more assets that maybe kick out have higher taxation tied to them and put those in the Roth, then that's going to be more valuable than having that, in something where we got to pay taxes along the way. So there's a lot of other pieces, even once we decide on the portfolio, of where we're going to own those asset classes. And Jason, I know not only are you strong with the CFA and the KAYA, the alternative asset, but you also have your CFP. So you've done a great job of just understanding, and the team incorporating different asset classes in different types of structures. I know a lot of things are happening in the economy, the country, and across the world. Tell us even just some of the themes, thoughts, things as we head towards and into this fourth quarter, into the year, but also longer term, 2026 and beyond.
Yeah, one of the things we're kind of always looking at is how to make the portfolios more resilient. As you mentioned, there's a lot going on with tariffs and with global debt and fiscal situations that don't seem to make a lot of sense. So are there things we can add to the portfolio, not just to reduce risk, because that's pretty easy to do. You can reduce risk, but you also reduce return. Are there things we can add that have low correlation to everything else that generate a strong return? So that's probably where we're spending most of our time.
And that's a great thought, because in our monthly investment meetings, whether it's talking about just where the U.S. debt is and where that's heading, to some of the different, what look like could be trade wars, and then tariffs and where those end up, I think it all ties back then to, for our clients to know that we are thinking about those things, we're cognizant of those things, but we're also saying, how does that fit within the context of the plan? No knee-jerk reactions, but I love how Jason said, how do we make the portfolio more resilient? How do we make sure we're still capturing the upside that the plan needs so our clients can be financially independent and make sure they're doing all the things that they want to do, but then also reduce down, some of those risks or some of the what ifs and stuff. So I wanted to tell you just how much we appreciate you and your team and what you're doing for our clients, and to thank all of our clients out there for entrusting us with not only their money, but then the comprehensive planning that goes with that. We know there's a lot of responsibility there, and we just want to thank everyone for entrusting our team. And Jason, thank you very much for your leadership, and we look forward to talking again in another quarter.
Sounds good. Should we go play a board game now, Ed?
Oh, yeah, the board. We're going to get out Wits and Wagers. I actually have that on my to-do list now to get. That sounds like an awesome game. Be pretty fun to do with the team as well, too, and just see how wild some of those answers are. So hopefully, worst case scenario out of this, you got a new board game for Christmas. And then also hopefully some helpful tips in how we're doing things here at McGill Jungie Wealth Management. So appreciate all of you. Have a great day.